Let's talk about accounting for merchandising operations. And so there's really only a few types of overarching businesses out there. You can provide two types of products. Those products are either physical goods or services. There's a third type, which we're not going to go into detail in this class, but you can learn about later, is like the right to access goods. We're talking about software and intellectual property or leases. We're not going to talk about that in great detail in this class. We'll keep it simple. There's services and there's physical products. That's what you're going to learn how to account for in this class. Later down the road, learning about software and intellectual property is actually quite fascinating and a really useful area of accounting that we can go into if anyone has questions during office hours. We'll focus on physical inventory and services in this class, and the physical inventory is what we're going to cover today. Right? So I could either sell you my consulting services or I could sell you a product. So we're going to describe, when we're talking about physical products we're selling, we're generally talking about merchandising. How do we sell something called inventory? We'll hold inventory on our books and sell it. And so there's lots of different styles of selling inventory. We're not going to go into great detail for all of them in this class. You'll learn more in managerial accounting, but we can make the inventory ourselves, right? We can own a plant, a manufacturing plant, and build inventory. We could sell water bottles that way, or we could build custom products, or we could build houses even and consider that kind of an inventory. We can build anything from as simple as selling a pen to as complex as selling an office building. And there's always multiple areas in the supply chain. We can produce the inventory, we can resell the inventory, we can wholesale the inventory. So you could have a store like, you could have a manufacturing plant that sells water directly to end users. You could have a manufacturing plant that sells it to a wholesaler like Costco that then sells it to end users. Or you could have a manufacturing plant that sells it to a wholesaler that sells it to a reseller like Target and then sells it to end users like ourselves. And so all of these different ways are different ways for us to sell physical goods. So it can be complex to report income for a merchandiser because we're selling inventory, and based on the revenue recognition principle, we have to recognize revenue in the time that we've earned it, and we have to match the cost to that revenue. So we capitalize the inventory. We have the inventory on our books until we are able to sell it, and then when we sell it, we recognize the revenue and the cost associated with the revenue, which is the cost of goods sold. And so what we're talking about here is, in previous chapters, we emphasized the service revenue, which is a bit simpler. As we perform the service, we recognize the revenue. And then our revenue minus our expenses will equal our net income. Just as we perform the service, as we've earned the revenue, we recognize it, and then we have our expenses related to it to equal our net income. Inventory for merchandisers is more complex because we have the manufacturer, like I mentioned, the wholesaler, which might be like Costco, the retailer, which might be like Target, and then the consumer ultimately purchases it. And we have to determine when revenue recognition would occur. When does the end party get a hold of that asset? And so it gets a little more complex on the income statement. We have this concept of cost of goods sold, which is not the same with services. We don't have this concept with services. So for a merchandiser, we have net sales minus our cost of goods sold equals something called gross profit. And then we have our other expenses, and that equals net income when we subtract out the other expenses. And so here's something that most people don't know, that you'll now know in this class. Profit and income aren't the same thing. Profit and income are not the same thing. A company can have a high profit, but negative income. You can have a high profit, but negative income. Profit is just our sales minus our cost of goods sold. So whatever our inventory costs, our direct inventory costs were, and we're going to go into how to calculate that. But our net income then subtracts everything else out, like our office expenses, our salaries, everything not directly related to the inventory, to the good itself. And so someone could tell you, hey, I have a really profitable business. Would you like to buy it? And then you, now being an accountant, now taking this class, could say, well, let me look at your income statement. What's your income actually? And then you might find out the only reason they might sell product at a high profit, but spend a lot of money on salespeople and actually have a negative net income. And you wouldn't want to invest in that business. Maybe their model is not sustainable. And so here's the difference. A service company is a lot more simple. You just have revenues minus expenses equals your net income. But you can see here for Nordstrom, it's much more complex. You have the net sales minus your cost of goods sold equals your gross profit, less your expenses equals your net income, right? So this is the two differences. And so make sure you understand those differences for your test. I could ask you questions on what would an income statement look like for a service company versus what would it look like for a merchandise company. Or I might ask you how to make sure you calculate net income or gross profit, or how are they different? So let's talk about inventory assets and the cost flow of a merchandising company. And so personally, I don't specialize. I don't really like physical inventory. It's rather complex. It's easy to understand for the layman. We understand how stores work, but it's rather complex to manage. And there's a lot of capital risk, right? Because we have to purchase the inventory. So we need cash. For a service business, I don't necessarily need cash up front. I could just perform a service. Or I could hire someone who makes money as they perform the service for me. But for an inventory-based business, I need to purchase an asset. In order to purchase the asset, I need money. So I either need to borrow money or have money available to buy the inventory. And then generally when I sell the inventory, I'll sell it on credit. Wholesalers and manufacturing plants sell it on credit to retailers. When I say selling on credit, I don't mean credit card. Get that out of your head. I don't mean credit card. I mean, we give them 30 days to 60 days to pay us, and then they might pay via credit card. But selling on credit doesn't mean selling on a credit card. It means giving them accounts payable, giving them a note saying pay us in 30 days. I then have to collect the cash in order to buy more merchandise. And I just make money off of the difference between what I purchased or made my merchandise for and what I sold it for. So it requires a large amount of capital investment, which requires a lot of risk when you have inventory-based businesses. And you need this cycle to continue to grow. If you want to learn anything, how this really works and the risk associated with it, I recommend there's a book about Nike. Everyone knows the shoe brand Nike. I'll send it out to everyone. It's a great book. I think you can get it for $10. But he talks about how he had to have millions of dollars in his business for his inventory and had really little cash for himself because you have to keep reinvesting the money into your merchandise. So it can be rather risky business if someone then doesn't want to buy your shoes. And so there's this calculation that you need to memorize, that beginning inventory plus net purchases equals our merchandise available for sale. And our which is also equal to our ending inventory plus cost of goods sold. What does this mean? How much inventory do we have available for sale? Whatever we start with plus whatever we purchased, or whatever we had at the ending plus whatever we sold. So let me show you how to use Google Notes to make this, Google Sheets to make this a little easier for you. So if I have a beginning inventory, I can put any amount here, plus net purchases equals my merchandise available for sale. I'm going to put a formula in here where I just say equal this plus this will give me my answer. And so anytime you have a question, if I have a beginning inventory of 1,000 and net purchases of 500, it will instantly calculate the correct answer. And I'll help you all build formulas to show you how you can leverage this for your homework and your assignments, because this is what you'll be using in your jobs, either this or Excel. So beginning inventory plus net purchases is going to be your merchandise available for sale. That's what we have available for sale.